All right, what is up, everybody? Today we're going to be talking about how tariffs can affect the stock market. I have a recent video about these slides, but we're going to go into the second half. First of all, this is not. This is only for financial, educate. This is only for educational purposes only. So speak with a financial advisor if you want opinions. Cash. Hey guys, what is up? Today we're going to be talking about how tariffs can affect stocks, and we're going to go more in depth about it. I recently made a video showing these slides, but today we're going to go into the second half of that video, or more in depth. How this video is going to go into more how people, businesses, and exporters and importers get affected by tariffs. So this is just a financial disclaimer that this is just only for educational purposes only. Feel free to read this, but let's get into it. So let me skip what went into the other day. So we were right here. So who pays a tariff on imported goods? So essentially, pretty much almost everybody pays into the tariff. Almost everybody pays into the tariff on a product. So if there's a tariff on steel, the steel coming in is going to be costing a lot more if it's from another country. So let's say, an example, if there's a 15% tariff imposed on electronics, well, if electronics costed $100, now they're going to be $115 to get them in the United States. And essentially, if someone sold these electronics for $120, or let's just say $115, they would bump their prices maybe to $130 a piece. But probably more to make the same margin, because companies really base a lot of their money off the percentage more so than the number itself. So companies would get absorbed by they would absorb the cost sometimes, cutting their profits, or they would pass it on to the consumer, you, at going to the store and having to pay more. So, and this chart goes into every time we had a tariff and the average percentage increase on said product that it got affected by. So relatively 10% increase. For the most part, some are more, some are less. It really varies and really depends. And these are just the estimated increases on those events. So, relatively speaking, even without a chart, most people know, even without looking at the data, that if you have a tariff, said product is going to cost more. So that's just what this slide is essentially showing for the most part. And the impact of tariffs on imported products or on import costs. So the big thing is that the thing that's at stake is that it reduces profits. It can have job cuts, weaker stock performance, and declining investor confidence. Now, actually, in my opinion, that it would boost jobs here, but maybe cut jobs elsewhere, cutting jobs from the country that we're importing from. And a lot of time it can, at least for the other countries more so, can squeeze the profits from said companies overseas like Toyota or foreign chip companies that we're getting, chips from. So a lot of time tariffs would affect them a lot more than us. And realistically, that's like in the last video, that's the whole point of the tariffs for the most part, is to help the nation more so than everybody else. It'll be more so, America first kind of mentality. And the main industries that get affected by tariffs, that have the most exposure to it at least, are manufacturing and retail. For obvious reasons, manufacturing would get affected the most because those are the ones typically at the center point of tariffs. If you have a tariff on steel, steel manufacturing in America is going to be protected. The ones elsewhere are going to get affected. Retail gets affected a lot, like clothing. If clothes made in China and it gets imported to here, clothes from China is going to cost a lot more. Whereas the clothes in the United States, they may not really get affected too much. Same for furniture, same for other industries as well. So, and this is an estimate of how much tariffs are going to affect both those sectors in 2025. The manufacturing inputs are expected to increase by 30%, and retail and textiles are expected to increase by 17%. But this is just estimated. This isn't official yet for 2025 because obviously 2025 is not completed yet. So, and this really varies day by day just because tariffs are, the news for it goes up and down almost every day. But we'll see what happens when at the end of the year as to the real numbers for all these and how it actually comes about. And a lot of the time, at least as of recent, a lot of these businesses are eating a lot of these costs for these tariffs because it's really hard to keep a customer if you're going to increase your product by 30% or 20% or whatever it is. Now, some businesses do increase those prices, but when you have that sudden price increase or cost of good, a sudden increase of the cost of good, it's kind of hard to pass it on to the customer quickly. It might happen slowly over time, but a lot of time at first, the companies really eat those profits, or eat those costs. So, and one of the big things with tariffs is a supply chain distribution. So global chains are all affected. Supply chain has been a big issue, especially since COVID, and a lot of them, a lot of them can get affected by tariffs. And if there's disruptions in the supply chain, then, it can create lower efficiencies, it can create lower profits, and, it can stir up a lot of things, especially for the outside countries, for the most part. It can affect the countries domestically as well. So just, and this chart kind of goes into, just a simple infographic of the supply chain or of a supply chain. So let me get my pen out, not laser pointer, pen. So realistically, you probably would have let me erase that. So you would have the supplier, the person making the product, and then you would have, which, be the one making it, and then you would have the manufacturer making the product from the raw materials, and then you have the distribution, which can be the ships and barges that are coming in on the coast. So that's where a 10% tariff, if I can do a 10% tariff can come in, or whatever percent tariff can come in and affect the company right here, the manufacturer, and they would have to eat those costs sometimes. Or if they don't eat those costs, they then make the retailer, you and me at the end, pay 10% more or whatever percent more. And that's how that would go. So mostly the end person gets affected the most of the time. The end customer gets affected the most a lot of time. Now, and this is just a simple graphic just to kind of show how that would kind of work. Essentially, the person making it would get affected the most. They would get affected the most initially, they'll get affected initially, and then they would distribute it. And then the distribution trying to come into the United States, they have to pay a 10% tariff. Well, now with that 10% tariff, They then got to throw it on to the customer, so now they increase their product by 10%, and now the retailer's paying 10% more. And then sometimes that retailer is a different company, so they would be putting 10% on top of it, so you have 10% and 10% on top of that. So it really varies by situation, but it's just kind of like a simple graphic just to kind of show how that would work for the most part. It's not, it's just a simple example. It doesn't have to exactly be like this, but that's and sometimes the supplier and manufacturer are the same person. Sometimes the supplier and the manufacturer are the same people, and then they just pass the cost down all the way down the line, and that's how that would work. And then it brings us into this, the impact on consumer spending. So if something costs more, it can make sales harder. If I'm used to buying something for $100 and now it's $110, it makes it a lot harder to sell said product. There'd be a lot less sales, especially if there's an initial hike in price. If a product went from $100 to $125, that's definitely going to hurt consumers, and it definitely affects sales. People may not buy that product anymore just because of the increase in price. So it can create weaker sales, and with weaker sales, you then can have companies like Target not perform as well, and if Target doesn't perform as well, they may not have as much earnings. Not as much earnings, their stock price can go down, and if the stock price goes down, the value of the company goes down, and inevitably, if the value of that company goes down, let's say other companies have the same problem, the whole entire S&P 500 can go down in said value. And that's how like a domino effect can happen. Now, that's just an example, but that's something that can happen. So, and getting into that, here is a chart of inflation essentially over the past 5 years. So this doesn't include any of the tariffs or really anything, but this is just kind of showing how the increases that we already had from all the things like milk, dairy products, pork, vegetables, non-alcoholic beverages, cereals, poultry. So this is showing that we already have increases in prices from inflation, but now we can have more increase on things on top of that. And eggs, that may have changed recently. I think eggs actually went down in value maybe recently, but this is over the past 5 years, so actually maybe up double. But this is just to show that things are already gone up a lot in price, and so tariffs can make things go up higher than they already are. And a lot of these products are inevitably, most likely, going to be going up, 2% a year or whatever it is, whatever the Fed tries to reach. So these things are already going to go up as it is year over year, but now they may go up a little more year over year. Things are already going to go up, but maybe go up a little faster. Whoops. So, and this kind of ties into the fact that when you have prices go up like this so quickly or so much, the consumer price index would go down. How the consumer would feel can go down. How would the average day consumer feel about a product can go down because of that. So, and as of late, I didn't zoom out this chart enough, but as of late, the consumer sentiment is down at pretty much all-time lows. So we're down at like 52, which is really, really bad. Really bad way to start off year 2025. Now, we did actually hit it halfway through June of 2022, and we haven't really hit it any other time. So people are really feeling a hurt ever since COVID happened. Ever since COVID happened, consumers have felt the brunt of inflation. And now, whether that's from money printing or other things, consumers have really, really obviously felt it and are at all-time lows. So hopefully things change and consumers feel a lot more confident about their purchasing power and, what they can buy and can't buy. But we'll see how these tariffs come into play and see if the consumer price index will go any lower after tariffs really come into full swing. So, but one of the and then that brings us into our next topic of electronics. One of the biggest things that can get affected by tariffs is tech stocks. The stock price, at least, can get affected a lot. I mentioned in the last video, and semiconductors, computer hardware components, all those foreign-made components into the computer can go up in price because of tariffs if they're outsourced somewhere else. Like if a lot of these computer components are made in China or other countries surrounding other Asian countries, that can make the laptops or the iPhones or whatever the product is cost a lot more. So if those other components cost a lot more, then the whole iPhone together will cost a lot more. And so with laptops, iPads, whatever else. And same goes for semiconductors and chips that go into the iPhones, especially in Taiwan where they make a lot of the chips, South Korea and China. If tariffs from those countries go up, then chips could cost a lot more, and it also can affect the supply chain as well as to how fast they can come here. So we'll see how the chips get affected. I know that's been kind of an up and down kind of situation, but if hardware components though get affected, then the overall product at the end, like an iPhone, can also increase in price. So we'll see where that goes, and I brought this chart in just to kind of show that tech really does not like tariffs. Being down over almost 30% from the tariff news has obliterated the stock for the most part, or all tech stocks. This is from the Vanguard Technology Fund. They're down 30% from the highs. They were down 30%. Now they did rebound a lot, but they went down a lot because a lot of tech is valued based on the future earnings of the company. Now, if you cut their profits in half, their future value is destroyed. So a lot of people maybe sold their stock or, lowered the price to a lower PE ratio to make it sound a lot more reasonable, or whatever the reason may be. Tech is very forward thinking, so they got affected the most because there's a lot of future value in them. So they got obliterated for the most part, but subsequently they did a pretty good V-shaped recovery right after, when we had softer tones on tariffs and push-offs till 90-day push-offs or whatever it was from pushing the tariffs off later on down the line. And also too, a lot of these tech stocks are anticipating as well the lowering of interest rates at tail end of the year and next year. So if that does happen and interest rates do go down, well then a lot of these companies, especially a lot of these tech companies, can take out loans for cheaper and be able to take out potentially more loans for their businesses to grow them even further and faster. And so my guess is as to why this V-shaped curve is so strongly is because they're already pricing in for the future, for the future of lowering interest rates, and that tariffs may not be as bad as people think they're going to be, and that a lot of this is going to be more so of a bluff in a way, and a trade negotiation kind of way. So, but this just kind of quickly goes over how another industry, like the auto industry, gets affected. Obviously mentioned like in the tech industry, all the components for tech can get affected, but the same for the auto industry. All the components for, a car can get affected, like the chips in the car, the raw materials, the steel, the thousands of parts that go into a car. They can get completely affected by the tariffs because the cars pretty much almost have everything in them. So they have a lot of vulnerabilities and they can get affected massively. And here's Toyota, a chart of Toyota when the tariffs happened. They went down roughly over 18%. So not nearly as bad as tech, but they still saw a lot from it, just because they are a they are a company outside the country. So in Japan, so they would get affected a lot by tariffs on them if they did increase. So the price did get hit hard and drop way down, but it did do really good recovery when we found out the really good news that at the time at the very bottom that they're going to push off the tariffs. Now they did go back down over time, and that may be because they're expecting tariffs to happen again. Maybe who knows? But that's just to show that this industry as well can get affected from tariffs. This other industry, the agriculture industry, can get affected as well, and that can be affected more so on the equipment side more than anything else. They can get affected more so like the tractors and the other equipment to use more so per se than anything else. The outsourcing of those products. And I brought this chart up just to kind of show that they had a really quick drop. They didn't last long down at the bottom. They went, they dropped down really fast, went really, really fast back up. Probably the fastest one out of any the industries mentioned so far. And they only got affected they only had like 11% drop. So they didn't really get affected that much. Now, they did prosper really well after. So they made really good headway in the other way pretty well. And this just kind of reiterates what I mentioned earlier about how exporters can get hit the hardest. How anybody outside the U.S. will get hit the most. And like mentioned before, domestic companies will benefit the most. The companies here will benefit more than anybody else. Jobs will be at least theoretically protected more, and products made here will get protected a lot more. And it will boost U.S. industries, hopefully a lot of time, tariffs at least, for steel, aluminum, cement, glass, textiles, solar panels, and batteries. A lot of time, though, this is like short-term gains from the protectionism. And a lot of time, the gains can be short-lived. They can see a real quick bump, but a lot of time they don't last forever. That initial price increase may not, last forever. And here's a real example. In 2018, the U.S. had a 25% tariff on steel, making this U.S. steel makers' profit, surge. And the demand fell, and then there's retaliatory tariffs, and then there's rising costs from imports, and then the benefits just became temporary. So, the market really didn't take that well, essentially, in the sense of, yeah, we did protect the business here, but, people in the market, really liked or got used to the prices that they already were at. Let's say they're $100 for whatever steel piece, and now they're $125. You really affected the market because now, one, they cost more, but two, you got not as many people buying it because they're so used to that cheaper price. And they did protect the people here, but protect the jobs here and all that. But at the same time, you lost interest from all the buyers. So, it's just a real life example of what happened in 2018 with the steel tariffs, which, they were good to protect the jobs here, which, you want, but at the same time too, it affected the consumer, the person buying the steel for whatever said reason. And this is just a real quick slide just to say that, throughout all these tariffs, there's a lot of roller coasters going on, and the sentiment can change very quickly and very fast on a dime. One real quick tweet can change the whole trajectory of the rest of the year for the most part. So we'll see what happens in these uncertain times and what will happen next. But the more volatility, that just creates lower confidence, and that just might create a lot of sideways action, which I remember a lot of people in the beginning of this year, especially in March and April during the whole Liberation Day and all that, where people were saying that, best case scenario, we just go sideways for the rest of the year. We go really high up, we go really low, we go high up again, we go low, just because, we got good news, we got bad news, and, I kind of stuck with that sentiment too from, in March and April when the market went down. And surprisingly, unexpectedly, the market turned right around. And so you never really know what's going to happen with the market. You may think, something may happen and then the other thing might happen. So, for most people, it's best just to have your money stay in the market and, let it just ride the waves, essentially. So, but anywho, that sums up the video. If you liked it, please subscribe, and see ya. Bye.